Hey everyone, welcome back to Corporate Decoder, the place where we deep dive into the financial statements of companies to uncover what is really going on behind the numbers. And in this report, we're looking at Farmer Brothers Company. And let's just say their latest report has some interesting developments to sift through. Brace yourselves because things are looking a bit cloudy for this coffee company. Today we are dissecting their quarterly report for the period ending the 31st of December 2025. What did they sell? How much did it cost? And what does that mean for their bottom line? Stick around as we decode the financials and see if Farmer Brothers is brewing up success or just a bitter cup. Let's start by looking at the company's financial health as reflected on their balance sheet as of the 31st of December 2025. Farmer Brothers had total assets amounting to roughly $151 million. This is a decrease from about $161 million at the end of June 2025. So where did that money go? One of the most visible changes is in their cash reserves. Unrestricted cash and cash equivalents saw a notable drop from about $6.8 million in June to just over $4 million by December. This suggests they've been spending cash perhaps on operations or investments, or maybe just to cover shortfalls. On the other side of the balance sheet, their liabilities also shifted. Accounts payable, which represents money owed to suppliers, increased from around $37.7 million to $38.7 million. This could mean they are buying more from suppliers or taking longer to pay them. Interestingly, their long-term borrowings under their revolving credit facility jumped significantly from about $14.3 million in June to $21.3 million by December. This indicates they are taking on more debt perhaps to manage cash flow or fund operations. Now for stockholders, this is a bit concerning. Total stockholders' equity decreased from about $43.5 million in June to $35.7 million by December. This means the owner's stake in the company is worth less at the end of the period. The main driver for this decrease seems to be a growing accumulated deficit, which went from negative $44.9 million to negative $53.8 million. That means the company has lost more money than it has made over time. Moving on to the income statement, the performance over the last few months. Net sales for the 3 months ending the 31st of December 2025 were $88.9 million. This is a slight decrease from $90 million in the same period last year, and for the 6-month period, sales were $170.5 million, down from $175 million in the prior year. These are not huge drops, but they show a trend of slightly declining sales. The cost of selling their products, however, has increased significantly. For the 3-month period, cost of goods sold was $56.7 million compared to just over $51 million last year. And for the 6 months, it jumped from $98.9 million to $105.8 million. This is a big red flag because it means it is costing them more to make and sell their products. And this is crushing their gross profit, which is what is left after you subtract the cost of goods sold from $38.8 million last year. It fell to $32.3 million for the 3-month period. That's a drop of almost 17%, and for the 6-month period, it fell from $76.2 million to $64.7 million. A drop of about 15%. This tells us their core business of making and selling profitable. Their operating expenses also saw an increase relative to sales, while they managed to keep selling expenses relatively flat general, and administrative expenses went up significantly, especially for the 6-month period. Operating expenses as a percentage of sales increased, meaning a larger chunk of their revenue is being eaten up by overhead. The result of all this is a substantial net loss for the 3 months ending the 31st of December 2025. They reported a net loss of $4.9 million, a stark contrast to a small profit of $210,000 last year, and for the 6-month period, the loss ballooned to $8.9 million from a loss of $4.8 million last year. This is not a good sign for profitability. Interestingly, the number of shares outstanding has increased slightly. This means when you divide the net loss by the number of shares, the loss per S share becomes even more pronounced for the 3-month period. The loss per S share was 22 cents compared to a profit of 1 cent last year, and for the 6-month period, the loss per share was 41 cents compared to 23 cents last year. Looking at comprehensive loss, we see a similar story. The net loss is largely unchanged when considering other comprehensive income items, which are often related to things like currency fluctuations or investments. The statement of stockholders' equity really highlights the impact of these losses on ownership value, as we saw earlier. Retained earnings, which is simply the accumulation of all profits and losses, has gotten more negative. This is a clear indicator of sustained unprofitability over time. Now let's talk about cash flow, because that is the lifeblood of any company. For the 6 months ending the 31st of December 2025, Farmer Brothers used $5.8 million in cash from operations. This is a big turnaround from generating $5 million in cash last year. So they are not only losing money, they are also burning through their cash reserves. Their investing activities also use cash, though less than last year. They spent $3.7 million on things like property and equipment. This is less than the $5.2 million spent last year, which might indicate planned capital projects are slowing down. On the financing side, they actually brought in $6.9 million in cash for the 6-month period compared to using $120,000 last year. This primarily came from drawing down on their credit facilities, which, as we discussed earlier, means they are taking on more debt to fund their operations. The net effect of all these activities is a decrease in their total cash and restricted cash by $2.6 million, leaving them with only about $4.4 million at the end of the period. This is a small amount of cash for a company of this size, especially given their operating losses. Diving into the notes, we learned Farmer Brothers is a leading coffee roaster wholesaler and equipment servicer, serving a wide range of customers from small cafes to large institutional buyers. They emphasize their commitment to quality and sustainability. It sounds like a solid business model on paper, but the numbers are telling a different story. They mentioned that the preparation of financial statements relies on estimates and assumptions that can affect reported amounts. The company reviews these estimates regularly, but actual results could differ. This is standard practice, but it is good to keep in mind that these numbers are not absolute facts. Looking at their leases, Farmer Brothers has significant obligations for building facilities, vehicles, and equipment. The total lease liabilities are substantial, indicating a commitment to maintaining a physical presence and operational infrastructure. Farmer Brothers uses derivative instruments primarily to manage exposure to coffee price fluctuations. They had some coffee-related derivative instruments designated as cash flow hedges, but these have all been settled as of March 2025. The impact on earnings from these hedges was minimal in the reported periods. Inventories remain a significant asset with almost $50 million worth of coffee tea and related equipment. This is a normal part of their business, but it is important to manage these levels to avoid obsolescence or spoilage. Their property, plant, and equipment net of depreciation is around $25.7 million. This includes a significant portion for coffee brewing equipment valued at over $18 million net of depreciation. The cost of maintaining and servicing this equipment is significant and is reflected in their cost of goods sold. They have intangible assets including customer relationships and trademarks, totaling nearly $8 million amortized and unamortized. These represent the value of their brands and customer base, which are crucial for long-term success. The debt situation is a key point. Their revolving credit facility has a commitment of up to $75 million, and as of the 31st of December 2025, they had borrowed $21.3 million on it, with a maturity in April 2027. This facility is secured by all their assets, and its terms include covenants that require them to meet certain financial ratios. If they fail to meet these covenants, it could lead to serious trouble. Farmer Brothers uses share-based compensation like restricted stock units and performance-based units. To incentivize employees, these plans are a significant expense and impact their overall financial picture. The company has a considerable number of outstanding and non-vested RSUs, which will continue to affect their compensation costs. Interestingly, they reported zero income tax expense for the 3 and 6 month periods ending the 31st of December 2025. This is likely due to their net operating losses, which can offset taxable income. This suggests that while they are not profitable enough to pay taxes now, they might have tax advantages in the future if they become profitable. The management's discussion section highlights the challenges they faced in the last 2 quarters. They mention increasing costs due to inflation, severe weather conditions, and labor market conditions. These are external factors, but also internal challenges related to executing their turnaround strategy. The company is clearly navigating a difficult economic landscape. Net sales saw a slight decrease of 1.2% in the last quarter and 2.6% over the 6-month period. This decline is attributed to lower sales volumes. Despite some price increases, the average unit price increased by about 9.3% for the quarter and 8.5% for the 6-month period. This means they are charging more for their products but selling less volume. The company explicitly states the decrease in gross profit was primarily due to increased costs of goods sold related to the rise in green coffee commodity costs. This is a direct hit to their profitability, making it harder to cover their other expenses. Operating expenses saw a decrease in selling and general administrative costs, which is a positive sign. They are trying to control overhead. The net losses on asset disposals also contributed to the overall picture. Interest expense decreased, which is good news, primarily due to lower pension-related interest costs. This is a helpful offset to some of the other cost pressures. Farmer Brothers also provides GAAP measures like EBITDA and adjusted EBITDA. These metrics aim to show a clearer picture of ongoing operational performance. By excluding certain items like taxes, interest, and depreciation, they report an adjusted EBITDA of $484,000 for the 3-month period and $1.8 million for the 6-month period, while still showing negative EBITDA, so profitability is still a major concern. Looking at the financial data highlights, the picture is quite stark. Net sales are down, gross profit margin has significantly worsened from 43.1% to 36.3% for the quarter, and from 43.5% to 37.9% for the 6 months. This means for every dollar of sales, they are keeping much less profit than before. EBITDA margin, which is supposed to show operating profitability without certain expenses, is also in negative territory for both periods. This is a clear sign that the core operations are not generating enough cash to cover their costs. Adjusted EBITDA margin paints a slightly better, but still concerning picture. Even after adjustments, it remains low, indicating the company is struggling to generate consistent operating profits. Farmer Brothers describes itself as a leading coffee roaster and distributor serving a diverse customer base. They emphasize sustainability and quality, but the financial performance suggests these efforts are not translating into strong profits currently. Their liquidity is a key area of concern. They are relying on cash flows from operations and borrowings under their credit facility to fund their needs. They have limited unrestricted cash, and a significant portion of their borrowing capacity is still available, but with ongoing losses and increased debt, this can become a tightrope walk. The negative cash flow from operations is a major red flag. They are spending more cash than they are bringing in from their regular business activities. This requires them to tap into other sources of cash like their credit line or existing reserves. Capital expenditures are projected to be between $9 to $11 million for the upcoming year. This suggests they are still investing in the business. But the source of this funding will likely be a mix of cash flow and debt. So what is the verdict on Farmer Brothers Company? It appears they are in a tough spot. Their sales are stagnating while their costs, especially for green coffee, are rising. This is squeezing their profitability hard. They are burning through cash and increasing their debt to stay afloat. The company is trying to control operating expenses and manage commodity price risks. But the overall trend is concerning. The significant increase in accumulated deficit and the negative cash flow from operations are major warning signs. While they are addressing market risks and trying to execute a strategy, their financial performance indicates significant headwinds. The declining margins and increasing losses suggest that the cost of doing business for Farmer Brothers is becoming unsustainable without a significant turnaround in sales volume, and cost management for investors. This report signals a company facing considerable financial challenges while they have assets and a well-established brand. The path to consistent profitability looks challenging right now. It will be interesting to see if their strategic initiatives can reverse these negative trends. Alright, that is our breakdown of Farmer Brothers Co.'s latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more community discussions and insights. Thanks for watching. See you next time.